While most investors chase the next hot trend, the wealthiest portfolios on Wall Street are built on blue-chip foundations. Forget flashy stocks. These 7 powerhouse blue-chip stocks that are not only delivering solid dividends but are also backed by rock-solid reputations, global operations, and time-tested performance. If you want stability and upside in 2025, don't skip this list. First up, ABBV, ticker ABBV. With a market value worth of $338 billion, ABBV is a pharmaceutical titan. They've built their reputation on groundbreaking treatments, especially in immunology. Medications like Skyrizi and Rinvoq have become major players in treating chronic conditions like Crohn's disease and rheumatoid arthritis. In 2025 alone, ABBV is expected to rake in nearly $60 billion in revenue, with even more growth on the horizon. On the dividend front, ABBV shines. Investors are enjoying a 3.5% yield, and the quarterly payout has more than tripled since 2015. That kind of growth in shareholder returns speaks volumes. What makes ABBV particularly compelling is its strong product pipeline and revenue consistency from top-tier drugs. The company's innovation in fields like oncology and neuroscience also opens the door for future growth. That said, there are some challenges worth noting. The expiration of patents on older cash cow drugs, especially Humira, raises the risk of revenue dips. Although newer products are gaining traction, navigating this transition will be key. But before we proceed, here's a quick question for you. If you could hold just one stock during a market crash, what would it be? And why? Comment your thoughts below. Let's see who's thinking long-term like a pro. Next on the list, AT&T, ticker T. With a legacy dating back to the 1800s and a market cap around $206 billion, AT&T is the definition of a corporate mainstay. It's a foundational name in the communications world, offering essential wireless and broadband services across the US. AT&T currently offers a juicy 4.0% dividend yield, a clear draw for income-focused investors. While the company restructured in recent years, spinning off its media assets in 2022, it's steadily reducing debt and focusing on its core telecom strengths. The appeal of AT&T lies in its role as a utility-like company in a digital world. People don't give up their phones or internet access easily, making its revenue relatively predictable. Its improving cash flow and modest payout ratio also suggest more dividend growth may be ahead. However, AT&T is not without its drawbacks. Growth is sluggish, and it faces intense competition from other telecom giants. Plus, the capital required to maintain and expand its infrastructure is enormous, but for those seeking reliability, it remains a strong candidate. Moving on to Cisco Systems, ticker CSCO. Cisco, with a market value around $254 billion, is one of the rare tech companies that balances innovation with consistency. Specializing in networking equipment, security, and cloud infrastructure, Cisco is the backbone behind many of the world's digital systems. What's more, it pays a 2.5% dividend, not something you see often in tech. That payout has grown by over 135% in the last decade. In the past 12 months alone, shares are up nearly 40%, signaling renewed investor confidence. Cisco's strength lies in its diversification into software and recurring subscription-based revenue. Its global footprint and financial health make it a dependable player in an otherwise volatile sector. But competition is intense. Fast-moving startups and evolving tech trends mean Cisco must continuously adapt. Also, a slowdown in corporate IT spending could hurt short-term performance. Still, its balanced approach makes it a strong long-term bet. Next up, Coca-Cola, ticker KO, the beverage king. With a market value of $310 billion, Coca-Cola is a cornerstone of the consumer staples sector. Beyond soda, their empire includes brands like Minute Maid, Powerade, and Smartwater. Its 2.8% dividend yield is supported by more than 60 consecutive years of dividend increases, a staggering achievement. In 2025, shares have climbed over 15%, proving that steady can also be strong. Investors flock to Coca-Cola for its unmatched brand recognition and extensive distribution network. The company's ability to adapt to changing tastes by expanding into waters, teas, and no-sugar drinks strengthens its resilience. Still, its growth is relatively mature, and with increasing consumer demand for healthier alternatives, Coca-Cola must continue innovating. Nonetheless, its global scale and proven track record provide a level of comfort few companies can match. Now let's talk about IBM, ticker IBM. Big Blue has reinvented itself time and again. With a market cap of $258 billion, IBM continues to make waves, particularly in AI. Its 2024 acquisition of Seek AI shows just how serious it is about staying at the forefront of artificial intelligence. Shares are up over 60% in the past year, which is impressive for such an established name. IBM also offers a 2.5% dividend, backed by over a century of operations and technological leadership. The company's strength is its deep relationships with government and enterprise clients. Its shift toward cloud computing and AI gives it future relevance, and its long-term contracts provide stability in earnings. But IBM has its challenges. It's often overshadowed by flashier competitors, and its brand doesn't carry the same excitement it once did. Revenue growth has been modest but consistent, and the company remains focused on long-term performance. Next up, JP Morgan Chase, ticker JPM. With a jaw-dropping market value of $747 billion, JP Morgan is the largest bank in the U.S. by assets. Its 2025 earnings report was the best in company history, driven by investment banking and smart acquisitions like First Republic Bank. JPM pays a 2.1% dividend and boasts a long history of weathering financial storms. It's led by the widely respected Jamie Dimon, whose steady hand has guided the bank through multiple economic cycles. JP Morgan's appeal lies in its dominance across all banking sectors and its resilient, diversified revenue streams. Its leadership, scale, and strategic agility make it a cornerstone of many portfolios. The flip side, banks are sensitive to interest rate shifts, regulation, and credit cycles. While JPM is more resilient than most, it's still subject to broader macroeconomic swings. But among financials, it's about as stable as they come. And finally, Johnson & Johnson, ticker J&J. J&J has been a staple of the healthcare sector for nearly 140 years. With a market cap of $376 billion, it's known for its diversified portfolio, from pharmaceuticals to medical devices. J&J's dividend yield stands at 3.4%, and the company has increased that payout for over 60 consecutive years. Even after spinning off its consumer health unit, J&J remains one of the most trusted names in healthcare. What draws investors in? J&J's bulletproof balance sheet, consistent innovation, and low volatility. It's one of just 2 U.S. companies with a AAA credit rating, a sign of exceptional financial health. Of course, there are concerns. Ongoing legal challenges and modest recent growth keep some investors cautious, but its stability, scale, and reliability continue to make it a favorite for defensive portfolios. To wrap things up, let's take a quick look at the data behind these powerhouse blue-chip stocks. When you line up the numbers, from revenue and market cap to dividend yield and earnings per share, a few key insights pop out. For starters, companies like JP Morgan Chase and Johnson & Johnson stand tall with massive revenues and strong earnings, showing just how resilient and profitable they are in their respective sectors. JP Morgan alone pulls in over $280 billion in revenue, while J&J backs that up with an impressive $89 billion and a market-leading EPS of $9. ABBV and CSCO, meanwhile, are solid performers when it comes to gross margins, topping 70% and 63% respectively, which means they're not just earning, they're doing it efficiently. That's a huge plus for long-term investors focused on profitability. Now, for income seekers, AT&T still leads with the highest dividend yield at 4.0%, making it especially appealing during market uncertainty. And while IBM might not be the flashiest name in tech, its 5.81 EPS shows it's still punching above its weight in earnings. Put simply, each of these companies brings something different to the table, from dividend consistency to strong growth potential or financial stability. The key takeaway here is this: blue-chip stocks aren't about hype. They're about dependable performance, solid fundamentals, and the kind of consistency that can anchor a smart portfolio through bull runs and bear markets alike. And hey, before we wrap up, here's something to chew on. Do you think the stock market rewards patience, or does timing really matter more than people admit? Drop your take in the comments. We'd love to hear your angle. And here are 6 most profitable growth stock you shouldn't ignore. Click on this video here.